Hi, everyone. Thank you for joining Wisdom Tree's office hours, Fed Watch with Professor Siegel, taking a summer vacation, where you'll be hearing from Professor Jeremy Siegel, Wisdom Tree Senior Economist, Jeremy Schwartz, Global Chief Investment Officer, and Kevin Flanagan, Head of Fixed Income Strategy.
Well, thank you everyone for joining us on today's call, taking a summer vacation. The professor is calling in on a slight vacation from traveling around Europe. So, professor, thank you for spending your evening here with us. We always love getting the professor's take on Powell. We've got some live earnings coming from some of the big tech companies. Maybe we'll get some commentary reaction to that as well. But, professor, what did you hear from Powell? What did you like? What did you not like? What's your latest?
Yeah, I'm on a cruise line between Belfast, Northern Ireland, and Liverpool. So I didn't know whether I would get to be able to talk to you, but so far it's good. But if we go blank, you know why it probably happened. All right, all right. I thought his talk was hawkish. Um, and so did the market clearly. As it went down, not dramatically, but given the low volatility of the last month or two, this was actually one of the bigger drops that we've had. Yeah, a couple things. First of all, his statement that we're modestly restrictive. Let me explain a little bit deeper on that. So the Fed funds rate is 4.33. The Fed says, that it's 3.0% is their non-restrictive rate. That's pretty far. I mean, one and a third percentage points is not just, modestly restrictive on that rate, which makes me believe he thinks that neutral rate is higher. And in fact, his statement later on was, yes, we talked about the neutral rate, and some of the people thought it was higher. There might be something that think it's higher than me. I mean, so like he's on the high side. He probably thinks the neutral rate is something like 3.9, and so 4.33 is not that restrictive as far as that's concerned. Yeah, of course, I will, let me say, I disagree that the Fed should be reacting to inflation that's put on because of a tax, and that's what a tariff is. That just is not what the models that I work with in monetary policy and theory said you should do. When there's you put on a tax, that's not a reason to tighten policy. I mean, if putting on a tax is restrictive in and of itself, why do you double down? Secondly, he made some interesting statements that he hinted at before. He said, yeah, goods inflation is beginning to go up, and now he said, and service inflation is beginning to really go down. And by the way, housing is really going down. Housing prices finally, we're seeing it in the FA monthly numbers. We're seeing it in the Case-Shiller numbers. That they're coming in below expectations. I think Case-Shiller is now 2% year-over-year home price, which is one of the lowest that it's had in absolute years. So there's and I've been surveying rental surveys from Redfin and Zillow and others, and they are also not going down. So I mean, if the sticky service sector is going down, and the only reason the inflation rate is going up because of the tariffs on the goods, I mean, why is he waiting? I think that's wrong. And again, we had this is the biggest in 23 years or something like that. The greatest number of dissents that we've seen on an open market committee. Now, he did say, I'm not going to speak for them. I'll let Bowman and, Waller speak for themselves as they will, in a day or two. He said, I'm not going to speak for them. He said it was also one of the better meetings. Everyone put out on the table what they wanted to do. He thought the discussion was very good. The question is are they in the right framework as far as that's concerned? He also made a couple confusing statements. At one point, he said there was downward risks on the labor market, and then he said, and then other places said it's very well balanced and very strong. Well, what is it? And then he said, well, yes, payroll is going down, but the supply is going down at the same time, and that's why the unemployment rate is basically unchanged. Well, the interesting thing is if you do pure theory, actually, if real growth is lower, and everyone's acknowledging real growth is lower. I mean, even though I wasn't surprised when the trade deficit came in yesterday, lower than expected, that it was going to bump up GDP. That did not surprise me. But, the first half of GDP, minus 0.5% and 3%, is a 1.2% real GDP for the first quarter. It was really quite low. And when real GDP goes down, that means real interest rates should go down. I mean, that means short-term real interest rates go down, which means the Fed funds rate should go down. So I think my feeling is the Fed funds rate should go down. I think the market was disappointed because there were reports in the last few days that Trump, his meetings with Trump ended sort of with a statement it's likely that we're going to be lowering in the future. Maybe it was read wrong by either Trump or his aides or someone else. I'm not quite sure the channels there. I think that got filtered into the market. And in no way, I mean, when he was asked about September, he did not, he said it depends completely on the data. And, of course, reminded everyone that there's 2 cycles of employment reports and 2 cycles of CPI reports. And before that, that he would be looking at to make that decision. By the way, the money supply did come out on the last Tuesday of the month. A little bit of perking up, but the year over year is just barely 4%. The same is true with deposits, by the way, which come out on a weekly basis. So I actually think the growth of credit, although not sharply contractionary by any means, is not really adequate for what I would say would be a growing economy. I think everyone is thinking that second half of the year we're going to be seeing the tariffs. We know they settled down. It looks like 15%, some exemptions. That is being argued. I'm not here to actually talk about that going on in tariffs. I will mention, and I think it was Goldman Sachs made an interesting commentary that under most favored nation clauses, if countries like Japan and the EU have zero tariffs on the U.S., then they have to extend that to a number of other countries, which actually is a positive, which means a lowering of world tariffs despite a rise in U.S. tariffs. They didn't. That's according to agreements. They didn't know whether those agreements would be honored in these circumstances or not. But they said if they were honored, that would be a positive impulse to world GDP growth that would counteract the negative effect on the tariffs. Nothing more to say.
Yeah, so let me give you some of the live. We got a few of the earnings reports. It's one of the things that the professor often talks about is AI is like one of the inflation offsets, and we got 2 of the big tech companies, Microsoft and Meta, releasing, and very positive. Meta came out, and our internal team chats where they shredded expectations, up like $3 billion more revenue than expected, so like 47 versus 44, something like that, and stocks up 8% in the first set of trades. Microsoft was up 5% in its first move after the first when it first flashed earnings. So it seems again positive.
Very positive AI. I mean, and with the tax bill and the immediate expensing and all that, it's there seems to be nothing really slowing that down, and there's a little bit of a perk up in the rotation, but nothing much. I mean, and with these two here, you're going to have probably a big growth versus value coming up, still on trend on what is happening. Obviously, usually we have to wait. They're probably giving forward guidance later, and of course the conference call will be important in terms of the forward the guidance. I mean, I think what everyone is really waiting for is when news reports are, gee, I used to buy this item from Staples or from Costco or whatever, and it was always $5.12, and now it's $5.40, and something like that. I mean, we're waiting for some really, when people see things that they know really being hiked, if they will, or are they going to be swallowed, by the exporter and partially by the importer, and to what degree that will happen. I think that everyone, including Powell did say, it's sort of implied it's this third quarter that we should be. He said we're seeing substantial tariff revenues, which means we are collecting at that rate. They're putting into inventory. They got to get it out of inventory. And how is the consumer going to react to that? And how are the firms going to price that? And is there not going to be enough consumer demand to pull it off the shelves at the post-tariff rate?
So, Professor, the next official Fed meeting is, say, roughly mid-September, but we're going to turn the calendar very quickly in the next day or so to August, so that means it is Jackson Hole time again.
Yeah.
So any thoughts? Do you think if we were to get some numbers on Friday that showed the employment situation cooling more than to Powell's liking, and the inflation numbers are sort of modest, do you think there's any chance he could guide us then towards a September cut?
Yeah, absolutely. I think he is really, if he sees now either, and the jobless claims are a little too noisy. We need to see 2, 3, 4 weeks of higher, and we haven't. But we're expecting 100,000. ADP came in fairly strong, although its correlation is not been great recently. We do know we had a 70,000 state and local increase last time. That kind of even boosted last time. If we get a little bit of a surprise on the downside, however, with the jobless claims and the jolts, we don't see other data that suggested. We should also look, of course, at the household, although we know that's much more volatile as far as that's concerned. But you're perfectly right. So the August report is like a midterm report, but if I remember, he doesn't take Q&A on the at all on the Jackson Hole report. So he has he'll and my feeling is that he won't jump the committee. If there's big weakness, he will mention it and suggest that if such continues, but it will not be. It'll be very, very cautious. And I don't know exactly what date it is. Was it August 20th or something?
Yeah, August 21st to August 23rd.
Yeah, okay. So we have 3 weeks. Of course, we're going to get Friday, and a few more jobless claims reports, and a few more inflation reports where we're going to see pass-throughs. But again, the thing that worries me is my opinion, and I'm not saying that every economist agrees with me, but I think most agree with me that increases caused by tariffs should not be justifying a tighter than normal. You have to look at post-tariff changes. You have to look at what's going on in the service sector, which he himself said today was favorable. I'm just worried about, by the time he starts seeing unemployment go up or job really goes down, and by the time we have a meeting and all that, it might be too late on the dynamics. But at this particular point, he has not changed his playbook at all. There would seem to be no bending whatsoever, and the two dissents seem to be didn't criticize them, but in no way changed his opinion.
We've gotten a couple of questions just to follow up on that, Jar. In terms of what you just said, Professor, he hasn't changed his playbook. And I'm beginning to hear it more in conversations. Is Powell becoming political, or do you think that's overblown?
Well, you see, it's almost, by being, it's political now because now, it's almost like, are the people that are wanting a cut, are they Trumpers? Are they, is Waller playing? He's been mentioned sometimes for a position, although not top spot. I mean, is Powell being stiff because he wants to show that he has backbone against Trump? There's no way, people say, and now it maintains its independence. There's no way, because now every position that's taken by an FOMC member is interpreted as pro-Trump or anti-Trump or whatever else. And that's unfortunate, but, it's not like, if he leaves, it's only, bends in. If he doesn't leave, it doesn't. Every person now, now being pro or anti-Trump could flavor their rational economic decision. And what are you going to do on that? I'm surprised at 2. I thought, I am. I mean, 2 is the most in 20 some years. That has to be taken into account. 2 dissents.
So it's interesting, Professor, as I teased the earnings from Meta and Microsoft, the expectations on Microsoft, I think were 8% better earnings growth than expected, and the stock is up, a little bit less than that, so a little bit contracting PE, you could say, in some ways. But there's a question came in on what PE levels would get you concerned about the market. It's sort of relevant to your cruise now. You're out with Bob Schiller, where people talk about valuations. Well,
he still talks about the CAPE ratio, which is astronomical, and has been for 10 years. Except maybe at the bottom of COVID. Look at right now. By the way, everyone takes 2025. Right now, theoretically, PE ratio should be based on 12-month forward. Well, we're almost on August 1st, which actually means the weight should be more on 2026 than 2025. Now, I've seen I think S&P is incredible. What is it? Is it a 17% increase? Kevin, I don't, we'll have to go to S&P. Don't have a really big increase is expected, but with probably a wide standard error, to say the least. However, again, you got the Mag 7 selling in the low, ex-Tesla selling in the low 30s. Tesla is another world thing. Selling in the low 30s. You have the median. I heard today median. I don't think was as low as what I heard. The median stock is 16 to 17. But, it could be that low, and the X-Tech is 1920. That's fine. It's not low, but it's okay. And inflation, interest rates and long 10 years low. This market, I think, is really fairly valued. which means with momentum positive. And I still think it could go up more. The only thing that would worry, if we really see the consumer begin to resist the higher prices, if they say, "Oh my goodness, I'm just not buying and I'm marshaling my money. I don't know how bad inflation will be," which we have not seen so far, even though consumption is not as robust as before. That would get me worried on softness. But that's where AI comes in to try to offset that. And firms are going to have to implement it, but it would be some softness in the consumer going forward. We have not seen that really yet.
So, it's interesting, Professor, when you say that. So let's take what I used to love to say on the trading floor. Take the other side of the trade. Say the Fed doesn't cut rates, and obviously there would be important reasons why they're not cutting rates, and rates just stay right where they are now. I mean, is that such a bad thing?
Well, the question, don't forget, there are $20 trillion worth of loans that are based on these short-term rates. The prime rate, credit card rates, auto loan rates, and everything else. So I mean, and not only that, our deficit. So I mean, trillions of dollars. So if you lower, I mean, I think it should be in the right, down 100 basis points, not all at once, but I think it should be in, given the tariffs, I think it should be in the low threes. I mean, that's a lot of interest savings to individuals. So you're being a little too tight. And again, credit is not expanding overly. So this is not recessionary. This is not at this point recessionary, although anything can snowball because of a shock or psychology. Once you get weakness, then weakness can feed on weakness. If there's a negative shock on top of that is unforeseen. But, as much as finance short term as is finance long term. I mean, he's right. He doesn't control the law. I mean, in fact, the truth of the matter is, if he does lower 25 or 50 basis points, I don't expect the long bond to do much, unless we go into a recession. Then the long bond will go down, but interest rate. But I mean, theoretically, you take recession off the table, which is one of the hedges for the long bond, and it's exactly what as that we predicted last September when it was 50 basis point lowering, and we said the long rate was going to go up, not down. I think the long rate was in the threes, high threes at that particular point.
Yeah.
Because everyone thought it was way too high and it was going to be a recession. And once you lowered 50, they felt, okay, that recession's off the table by a greater extent. Now, there's the uncertainty of this. Again, I don't see money growth at a level. If I started seeing money, if they lowered 50 basis points, 60, and I see money growth really accelerating to 7-8%, I would say, whoa, okay, you better step back. At this particular juncture, I see sluggish money growth, and loan growth. It's consumption growth. I mean, people are not taking out HELOCs. They're not taking out home equity loans. This is what, small businesses, it's really expensive for them. They pay 3, let's say, LIBOR plus 3, what are they paying? 7, 8, 9%. Well, with consumption going up at, 1% plus whatever inflation might be, 2, that's a big expense. So, the question is, does Powell and the Fed want to lower that big expense so that the consumer and small businesses can weather the negative impact of tariffs that are upcoming?
Kevin, on the fixed income positioning side, there's been a few questions on, how do you position for the second half of the year, given all that we're hearing? Anything you would say on the positioning on fixed income?
Well, we've continued to focus on the active passive barbell, but if you do want to think ahead, if we are going to get into a situation where the Fed does cut rates, and it's not because, to the professor's point, it's necessarily recessionary. The yield curve is going to steepen in that environment. So, what we would look to do is maybe try to find something in the 1 to 3 year area, like our short-term yield enhanced ag, ticker SHAG on that. That could be an area that would tend to, I think, outperform the intermediate, the belly part of the curve, something to look at. So we're not quite there yet, but that's kind of like keeping our powder dry as to perhaps what could be the next move that we look at going forward. And a lot will depend upon, to the professor's point, if the Fed does cut rates, why are they cutting and by how much? Is it because, okay, tariff-induced inflation didn't show up and they believe what Waller has been saying, that, employment is not as strong as it appears to be, if you look at other metrics, or, is it a concern of a recession? So that would be a different environment. I think if there's a recessionary concern, then you probably want to look at that intermediate part of the curve. So just like the Fed, a lot of what we're looking at here in bond strategy is data dependence and what you think the Fed's going to do and why is the Fed going to do it.
I think in equities, the big question is the rotation from these big tech leaders. Like, you get earnings reports today, they continue to keep going, and versus the smaller cap companies are very different valuations. When people ask about the valuation questions, and the first question on P ratios being too high, yes, you could say they're higher than normal for mega caps, but for small caps, it's the opposite. They're very, very depressed relative to their history. And so the question is, what gets their earnings better, margins improving? Some of the value strategies we look at, 13, 14 PE, 7% shareholder yields, doing a lot of buybacks. So I think that in the U.S., I think for the valuation concern, our value fund WTV is a good one to manage that risk, but also being tilted away from the mega cap. So I think that's one of the big stories of the eventual rotation.
Yeah, we again, when are firms really going to use the AI to cut? I mean, is the tariff going to be the prod and the excuse? It's hard to fire people, and the cost of hiring is high. The cost of firing is high, and the cost of hiring is high. So that's why we really see elevated continuing claims and still very moderate, initial claims. People are not finding jobs. There's no hiring, but there's no firing. But suddenly the tariff and all the inventory they bought at low price is gone. And now, do I raise 10, 15%? It's not going to be necessarily all that amount, because there's already they have their margin on top. So if they double their the prices on that, and they keep that margin the same, it won't be as much, but still they're going to be facing the higher price. I mean, everything that comes from China is going to be higher, and everyone's going to try to push it around other countries that are lower and try to make that work. But I think those costs are going to come through, and that's going to depress real consumption. And it's a tax. It's a tax, and as I've said before, I mean, in the big picture, we should be going to a consumption tax. It shouldn't just be on imports, and it should be a general tax, and get rid of the income tax, really. But that's a much broader subject. This is sort of a baby step in a weird way that I think is unbalanced towards a move to what I would consider an idealized tax system. Not trying to justify these tariffs. I mean, I still think they're net negative, but with the immediate expensing, the other permanent tax cuts, with the AI being the prod to move forward, with this most favored nation perhaps lowering tariffs, and we are going to get some business on the other side. I mean, let's not discount that. by lowering tariffs on the other side, we are going to get a little bit more business, but a lot of things we sell that isn't what they want to buy, but nonetheless. So with all those things, you could get a lot of mitigation. All those other things are really a lot of mitigation, and that's why the market continues to go up. It could be full mitigation on everything else. So the other things that are happening are really plus, and then they could be +8, and tariffs are -4, so you're still plus. Yeah, that's kind of what I see.
Well, Professor, we'll let you get out of here. Go back. Thanks for from your summer.
Yeah, from the Irish Sea. Thank you for letting me into your computer.
All right, always great talking.
I will. I'll see you again certainly next, and even before. Maybe we'll have a meeting right after POW in August.
Thank you, Professor. Kevin, great to be with you as always. And you can find us on our office hours, Behind the Markets podcast, Kevin Basis Point podcast for Kevin's weekly wrap on fixed income. Thanks for dialing in.